If you're trying to day trade Apple stock based on an article you just read on Yahoo Finance, you are already too late. You're playing a game where the rules are entirely rigged against you. Most beginners treat the stock market like one giant pool. They think a stock is just a stock. But behind the scenes, the market is actually divided into 3 distinct weight classes. The rules of how these stocks move, how much extra they are costing you to trade, and most importantly, where do you actually have an information edge, change completely depending on which size you are trading. If you don't know the weight class, you don't know the rules. Let's break them down. Tier 1 is the mega caps. Think companies Apple, Microsoft, Nvidia, Amazon, and Meta. These are the fortresses, worth hundreds of billions or even trillions of dollars. Because these companies are so massive, everyone is trading them all the time. To understand why this matters for your wallet, you need to understand the bid-ask spread. When you open Robinhood app and hit buy an Apple stock, Robinhood usually sends your order to a giant middleman called a market maker. This middleman holds an inventory of the stock. They buy it at a slightly lower price, the bid, and sell it to you at a slightly higher price, the ask. That tiny difference, the spread, is their profit. And here is the secret. That spread is entirely based on inventory risk. With megacaps like Nvidia, millions of shares change hands every second. The market maker can buy and sell instantly, meaning they take almost zero risk holding the stock while the price drops. Because their risk is so low, the spread is incredibly tight, often just a single penny. You can trade these giants all day and lose almost nothing to fees. But the downside? Because thousands of Wall Street algorithms track every move Apple makes, the market is mathematically hyper-efficient. By the time you hear good news, the computers have already priced it in. You have almost absolutely zero information edge here. Next, we step down into Tier 2. Mid-caps. These are established companies, usually worth between $2 billion and $10 billion. They aren't wild startups anymore, but they aren't tech monopolies yet. For intermediate traders, the biggest catalyst for a mid-cap stock isn't a good earnings report. It is index inclusion. When a mid-cap company grows large enough and its financials become perfectly stable, it gets tapped to join a major index like the S&P 500. This is the holy grail. Why? Because of forced passive buying. Trillions of dollars sit in passive index funds and ETFs that are programmed to blindly track the S&P 500. The second a mid-cap gets officially added to that index, the computer systems running those massive funds are legally obligated to buy millions of shares of that stock immediately to update their portfolios. They don't care what the price is. They have to buy it. The strategy here isn't to wait until the stock is added. The real edge comes from analyzing top-tier mid-caps and positioning yourself in the ones most likely to graduate into the big index before the trillion-dollar algorithms are forced to buy. Finally, we have Tier 3, small caps, companies under $2 billion. This is the Wild West, and it is the only place retail traders have a massive structural edge over Wall Street. Why? Because the big money literally isn't allowed to play here. If a $50 billion hedge fund tries to put just 1% of its money into a $100 million company, they would accidentally end up affecting the valuation and stock price massively and trigger an SEC investigation. So, the giant algorithms ignore these stocks entirely. It's just retail trader versus retail trader. Since the trade volume and tracking is the least in these stocks, news and information about them gives the biggest edge out of all the categories. But the real secret to trading small caps is understanding the float. Beginners look at the total shares outstanding. Intermediates look at the float, which is the number of shares actually available to the public to trade. If a small cap company has a great product, but the CEO and early investors lock up 80% of the stock and refuse to sell, the public float is incredibly tiny. When good news hits that stock, thousands of traders rush in to buy. But because the float is so small, the supply simply isn't there. The price doesn't just drift up. It violently explodes upward in a supply shock. So, the next time you're looking at a stock, Don't just ask yourself if the share price is cheap. Ask yourself, am I swimming with algorithmic killer whales in a megacap, trying to front-run an index draft in a mid-cap, or hunting for a low-float supply shock in a small cap? Know your weight class, and you'll finally know how to play the game. Hit subscribe if you want to understand the actual mechanics of the market, and I'll see you in the next one.